Imagine quadrupling your money in just a matter of years. Sounds impossible, right? Not in the world of investing, especially not in 2024. Welcome to the new era of investing, a realm where the impossible becomes possible, where your hard-earned money works tirelessly for you, multiplying in value. This isn't the future. This is now. In 2024, investing is not just for the Wall Street tycoons or the mega rich, it's for everyone. It's for you. And it's simpler than you might think. With tools like stocks, bonds, and mutual funds at your disposal and a world of opportunities at your fingertips, investing is more accessible and rewarding than ever before. But how does it all work? Where should you put your money? And most importantly, how can you avoid common pitfalls and fears? We'll answer these questions and more as we delve deep into the thrilling world of investing. So, hold on tight as we navigate the exciting world of investing. Before we dive into where and how to invest, it's crucial to understand the basics. Think about investing as a game. You're the player, and the financial market is your playground. Now, there are different toys you can play with. These are your investment options. Let's take a look at 3 of the most popular ones: stocks, bonds, and mutual funds. Imagine stocks as owning a tiny piece of a company. Yes, you heard that right. When you buy a stock, you're essentially buying a piece of a company and becoming a part owner. If the company does well, your piece of the pie grows, and so does your wealth. But if the company stumbles, your piece shrinks. It's a bit like riding a roller coaster, thrilling but potentially stomach-churning. Next up, we have bonds. Bonds are a bit like IOUs. When you buy a bond, you're lending your money to a company or government. In return, they promise to pay you back with interest after a certain period. It's like lending money to a friend who promises to return it with a little extra as a thank you. Bonds are generally considered safer than stocks, but the returns can be lower. Lastly, we have the Swiss Army knife of investing: mutual funds. A mutual fund pools money from many investors to invest in a diversified portfolio of stocks and bonds. It's like going to a potluck dinner where everyone brings a dish. You get to taste a variety of flavors without having to cook everything yourself. Mutual funds offer diversification, which can help reduce risk, but they come with their own set of fees and complexities. In a nutshell, stocks, bonds, and mutual funds each have their own perks and quirks. They can all play a role in your investment strategy, depending on your financial goals and risk tolerance. Now that you've got the basics down, let's explore where you can put your money to work. So you've got some money, and you're ready to invest, but where should you put it? In 2024, you have a myriad of investment options to consider. Let's talk about 3 of them: individual stocks, index funds, and real estate. First, individual stocks. These are shares of a company you can buy. When you own a stock, you own a piece of the company. The advantage? Potentially high returns. If the company does well, so do you. But remember, with high reward comes high risk. If the company struggles, your investment could decrease in value. Next up, index funds. An index fund is a type of mutual fund that aims to replicate the performance of a specific index, like the S&P 500. The advantage here is diversification. Instead of betting on a single company, you're spreading your investment across many. This can help mitigate risk. However, returns can be lower than individual stocks because you're not just investing in the top performers. Lastly, real estate. This could mean buying a property to rent out or investing in a real estate investment trust, known as a REIT. The advantage? Real estate can provide a steady income stream and potential appreciation over time. But keep in mind, real estate requires more hands-on management than stocks or index funds. And property values can fluctuate, sometimes unpredictably. Each of these investment options has its advantages and disadvantages. Individual stocks may offer high returns, but they come with higher risk. Index funds provide diversification, but their returns can be more modest. Real estate can generate steady income, but it requires more time and effort to manage. Your choice will depend on your financial goals, your risk tolerance, and your investment horizon. Do you want potentially high returns and don't mind the risk? Individual stocks might be for you. Are you looking for a more hands-off investment? Consider index funds. Want to generate a steady income stream? Real estate could be your best bet. Remember, diversification is key. Don't put all your eggs in one basket. Keep a mix of different investments to spread out risk and increase potential returns. The world of investing is at your fingertips in 2024. It's time to make your money work for you. Investing can be scary. The risk of losing money can be daunting. But don't let fear stop you. Think about it this way. Fear in its most basic form, is a survival response. It's there to protect us from potential harm. And in the world of investing, this harm is symbolized by the possibility of losing money. But just as we've learned to manage fear in other aspects of our lives, so too can we manage it when investing. One common fear is the fear of the unknown. When you're just starting out, the world of investing can seem overwhelming. Stocks, bonds, mutual funds, it's a lot to take in. But remember, every expert was once a beginner. The key to overcoming this fear is education. Learn as much as you can about different investment options, how they work, and the risks involved. Knowledge truly is power when it comes to investing. Another common fear is the fear of loss. No one likes to lose money, but it's important to understand that investing is not about never experiencing loss. It's about managing risk and making decisions that have a good chance of leading to long-term gain. Diversifying your investment portfolio can help spread the risk and potentially reduce the impact of any one investment performing poorly. Then there's the fear of missing out, or FOMO. Seeing others make money from investments can make us feel like we're missing out. But remember, every investment comes with its own set of risks. Just because someone else is making money doesn't mean that the same investment is right for you. Finally, it's okay to ask for help. If you're feeling overwhelmed or unsure, consider seeking advice from a financial advisor. They can provide guidance and help you make informed investment decisions. Remember, investing is not about making quick gains. It's about growing your wealth over time. So don't let fear hold you back. Instead, use it as a motivator to learn, to strategize, and to make smart investment decisions that align with your financial goals. You've got the knowledge, you've got the tools. Now it's time to take the leap and start investing. So where do you begin? Well, first things first, you need to set some financial goals. What are you saving for? A new house, your retirement, your child's education, or maybe just a rainy day fund? Determine what your financial goals are and let those goals guide your investment decisions. Next, you'll want to start researching investment options. There's a whole world of choices out there, from stocks and bonds to index funds and real estate. Take some time to understand the pros and cons of each option. Remember, what works for one person may not work for you. So it's crucial to choose investments that align with your financial goals and risk tolerance. Once you've decided on your investment strategy, it's time to jump in. But don't just dive headfirst into the deep end. Start small, invest a little bit of money at a time. This approach, known as dollar cost averaging, can help reduce the risk of making a large investment at the wrong time. And of course, remember to monitor your investments regularly. The world of investing is always changing, and what was a good investment yesterday may not be a good investment tomorrow, so stay informed. Keep an eye on your portfolio and make adjustments as necessary. Finally, don't be discouraged by setbacks. Even the most successful investors have had their share of losses. The key is to learn from these setbacks and keep moving forward. After all, investing is a journey, not a destination. And there you have it. You're now ready to take on the world of investing in 2024. Remember, the journey of 1,000 miles begins with a single step. So take that step, start investing. The future is in your hands.